Finally, we actually got some good economic news today. And we really haven't had any for quite a bit of time, going all the way back to about a year ago when mortgage rates and everything started to change. Um, so I want to talk today about what happened with mortgage rates. I mean, mortgage rates today dropped, within just a few hours, down over 0.5%. Now I know that depending on who your loan officer is and what market you're in, rates can be a little bit different. But mortgage rates went from about 7% to 6.5% within just a few hours. And I wrote an article on this that I did post in the Agent Investor um, group, but I know that some of you don't want to read an article, and maybe the article is a little bit too boring and too technical. Um, Not necessarily that me driving in my minivan right now is a lot more exciting, but maybe you just kind of want to hear my voice rather than reading the article. So I do want to talk a little bit about why mortgage rates dropped today, where mortgage rates might be going, and why this is such a big deal. I mean, I think all of us kind of know why it's a big deal. Um, but man, you know, just about a year ago today, mortgage rates were right at about 3%. About a year ago today, buyers were legitimately, fighting each other to overbid on properties. Buyers were waiving inspections, waiving contingencies, um, offering whatever, because at the end of the day, buyers buy houses based on one thing, which is their monthly payment. Buyers don't care. A house could be $500 million, but if the interest rate is almost zero and their monthly payments can be 3 grand a month, they will buy that house. They don't care what the actual principal of the property is. We've probably never had a time, I know I've never been in real estate, where rates went from 3 to 7% up, more than double in the course of like a 90-day period. So this had a dramatic impact on every market across the United States. We went from buyer demand being at an absolute all-time high to buyer demand dropping off a cliff. Now, it's not that buyers don't want to buy houses. Buyers still do want to buy houses. In fact, we still have an incredibly low amount of inventory on the market. But having an incredibly low amount of inventory on the market is only one component. If somebody can't afford the monthly payment because interest rates are 7.25, 7.5, 7.5%, they just can't buy a house, period. So we have seen buyer demand change, I mean, really quick. Again, from 10 out of 10 buyer demand to probably more like 3 out of 10 buyer demand. And again, this is different in different markets across the country. There are some markets across the country where buyers are really, buyers are really in the driver's seat. They're really controlling what's going on. And then, in a market like mine, in the greater Boston market, we went from extreme buyer demand to just, cooling. But, you know, there's been a lot of anxiety and a lot of discussion and a lot of thought to, well, where are things going to go in 2023? Like, is this, buyer demand that fell off a cliff kind of temporary or not? And I've always said, and I'll continue to say, that mortgage rates are really the number one, 1A, 2, 3, top variables, right? Everything else is a far cry, like from what's going to matter. So I want to talk quickly about, like, why did mortgage rates even go up? Now, a lot of you might know this. If it's repetitive, you'll probably still take a few things from it. But at the end of the day, the Federal Reserve only has one tool to knock down inflation, which is to raise interest rates. So the Federal Reserve raises interest rates, and typically speaking, mortgage rates fall almost directly in line with the Federal Reserve rate. So, for example, if the Federal Reserve rate is 3%, typically mortgage rates are going to be 6 to 7%. If the Federal Reserve rate is 0, mortgage rates are going to be like 3 to 4%. And we've seen this. I mean, it makes sense, obviously. And the Federal Reserve only has one tool to bring inflation down. I mean, inflation is a really, really bad thing. I mean, it robs people of their purchasing power. It creates a lot of trouble for everybody, especially people that are on a fixed income. And it does impact everybody. I mean, unless you are ultra wealthy, inflation impacts you, right? So inflation is a bad thing. We know it's a bad thing. The Federal Reserve only has one tool to potentially help inflation, which is to higher the interest rate. So they've been doing this. And ever since they've been raising interest rates, businesses and real estate have been really, nervous, because we've all been, I don't care whether you're a real estate agent, an investor, a flipper, a buy and hold person, we've been in this economic environment for the past 5, 6, 7 years where interest rates have been incredibly low. We've all operated our businesses on low interest rates. Okay. We've all been in this environment. We've been in this environment for a long time. And we've learned how to do well in a low interest rate environment. And then inflation happens, the Federal Reserve raises interest rates, and boom, all of a sudden, overnight, we are in still not a crazy high interest rate environment, but much higher than what we're used to in the past. So this all matters. And we've all been waiting where inflation is going to go, because the only reason the Federal Reserve is, even with job losses, even with faltering, is simply because they want to lower the rate of inflation. Interest rates to potentially lower inflation. So we've all been looking every single month to measure inflation, which is ultimately what we call the CPI, the price index. And that comes out once a month. So what we've been looking for every why mortgage rates have continued to go up is that pretty much each and every raising interest rates, we have not seen a decline in inflation gone down. And every single month, when inflation looks like it's not going down, the Federal Reserve is going to continue to have to raise interest rates. The stock bond market gets crushed, and mortgage rates go back up. Okay, back to like June, July, mortgage rates were in the 5s, and inflation keeps going up. And as the Federal Reserve keeps raising rates, we bring in this man. Please, 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 let me wake up to a CPI report to an index lower than the previous month, so that maybe, just maybe, back down, and maybe, just maybe, buyer demand can start to snap back. So 8:30 today, CPI was reported, and it came lower than anticipated. And as soon as that happened, now keep in mind, as CPI came in, consumer price index came in, inflation was lower than anticipated. It's still really, really high. I think it came in the high 7s. It's still, but it was lower. So what that says to the Federal Reserve, people that are watching the stock market, the bond market, etc., is maybe the Federal Reserve won't raise interest rates as high, and maybe just maybe, interest rates will. So as soon as that happened this morning, as soon as the consumer price index got reported, the bond market, man, it was nice. It was nice. The yield, the 10-year Treasury yield went from about 4.2 to 3.8 an hour. And as soon as that happened at 8:30, I did a post on my Facebook saying mortgage rates are going to have a nice little dip today. Going to have a nice little dip. You know, I follow Mortgage News Daily, and they went from about 7% to 6.5%. Is a huge one-day move, enormous one-day move. With interest rates going from 7 to 6.5, is the market going to like go back on fire? No, they're still more than double what they were a year ago, or maybe they're just double now. So this is just day one. And also the stock market, I mean, certain real estate stocks in particular, I saw Redfin was up like 20 to 30% today. With the hopes that the real estate market in 2023 a little bit better than what we hoped. And again, today is necessarily to celebrate. Today is a day we have optimism. We have optimism. We have optimism. Mortgage rates will start to dip. We have optimism. Buyer demand will snap back a little bit if rates drop. We have optimism. The economy won't completely tank. You know, it's already getting damaged, but maybe it won't. So today isn't a day where we know anything definitive, because this is only measured October consumer price indexes today. It fell a little bit. And you know what? Optimism feels really good right now. Because guess what? The last 90 days have not been very optimistic. So, you know, big impact on where things go in 2023. 2022 is pretty much, and then the beginning of 2023, you know, it's winter time, January, February, not a lot. Everything's going to kind of come to light in March, April, and May of 2020. A lot more consumer price index readings. There's going to be a lot of job losses or job gains, or there's going to be a lot that. But for today alone, there's some optimism in the air, and if you're going to be feeling the effects today, you're going to be feeling good today. So anyway, give you guys, you know, this economic update. You know, most of you guys know real estate. I love talking about it, and I hope that this was helpful to all. And today is definitely not a day to, you know, overly celebrate. Cautious optimism. All right, guys. Thank you for tuning in. I will talk to you later.